Hi, my name is Michiko.
My name is Cathlin Valerie.
And I'm Michael Brandon.
Today we're going to present about assets,
Liabilities.
And equity.
Assets can be defined as objects or entities that the company owns that have economic values. It provides future services and benefits. There are two types of assets. First, tangible assets are physical entities that a business owns, such as land, building, vehicle, equipment, and inventory. Second is intangible assets. These are things that represent money or value, things such as account receivable, patents, contracts, and certificate of deposit. Assets are also grouped according to either their lifespan or liquidity. Current assets are items that are completely consumed, sold, and converted into cash in 12 months or less. Example of current assets includes account receivable and prepaid expenses. A fixed asset is a long-term tangible piece of equipment or property that a firm owns and it is used in operations to generate incomes. Fixed assets are not expected to be consumed or converted into cash within a year and usually longer. Fixed assets might include machinery, buildings, and vehicles, and mostly appears in balance sheets as a property or equipment or plant. Fixed assets are also referred as capital assets.
Liabilities are the debts or financial obligations of a business. In other words, the money the business owes to others. Liabilities are classified as current and long-term. Current liabilities are debts that are paid in 12 months or less. It may include account payable and customer deposits. Current liabilities are usually paid with current assets. Managing short-term debts and having proper working capital is important to a company's long-term success. Long-term liabilities are typically loans used to purchase or maintain fixed assets that are paid off in years instead of months.
Equity is the most important thing for a business owner because it is the owner's financial share of the company or the portion of the total assets of the company that the owner fully owns. Equity may be in assets such as buildings, equipments, or cash. Equity is also referred to as net worth. For example, you purchase a $3,000 phone with $2,500 loan and $500 cash. It means you have acquired an asset of $3,000 but have only $500 of equity. There are three types of equity accounts. These accounts have different names depending on a company structure. First of all, contribution. There are times when business owners need to invest into their own company. It may be a startup capital or a later infusion of cash. When this activity occurs, a capital or investment account is credited. Next is distribution or draw. If a business is profitable, then the owner often wants some of the profit returned to them. To track this activity, a distribution or draw account is debited. This is the only equity account that is debited.
Last, accumulation from prior years. It is to track a company's net income as it accumulates over the years. On the first day of the monetary year, most accounting programs automatically credit this account with the previous year's net income.
To close our presentation, here are some of our opinions on why accounting is important. First of all, it is necessary for getting investments and loans. Without an organized accounting book, the financial statement, financial forecast, and profitability claims won't be accurate.
Second, accounting can help guide the decision making so you can avoid common business mistakes such as underspending or even overspending.
Last but not least, it is because accounting keeps you organized. It shows you exactly what your business has been up to when it is come to finance. It keeps you organized because you can accurately and legally fill out your tax return.
Thank you for watching.
We hope by watching this video, you're able to understand the basic formula of accounting.